Okay, so now we're going to talk about actually digging into it and obtaining audit evidence by performing substantive test of details. Okay, so we have a whole bunch of different tests that we could perform when gathering this audit evidence. And because we're starting with revenue, what the auditor is going to do here is audit the revenue line item in the income statement, all right? But when it comes to revenue, there's generally going to be an impact to either the cash balance or the account receivable balance on the balance sheet, depending on whether the sale was made on credit or in exchange for cash. So for the purpose of understanding this, what we're going to do is break up all of our transaction level assertions from all of our account balance level assertions, meaning that everything that is going to impact the income statement is going to be separated from how we're auditing the balance sheet. But in reality, just keep in mind, the auditor might be doing this simultaneously. Okay, so understanding the revenue cycle for your exam is going to be very important, all right, paramount even. And we already talked about management making relevant assertions to the auditor. Right? They're saying something with confidence to us, the auditor. They're saying that everything is complete. They're saying that everything is in the correct time period, that everything is valued properly, right? Everything has occurred related to these transactions. So now what we're going to do is take each of these assertions and understand what is the most appropriate test for the auditor when obtaining this audit evidence. Okay, so once again, focusing on the income statement when it comes to revenue. We have the completeness assertion. So anytime you hear the word completeness, you're going to think of the word tracing. So tracing isn't always going to be the most appropriate test, but very frequently the auditor can obtain evidence related to management's completeness assertion by tracing from one source document all the way to the financial report. Okay, if we were vouching, we would be going just the opposite direction, right? We'd be going from the report all the way to the sales document, right? So that would generally be testing for more of an existence assertion. Okay, so because we're testing for completeness, we're going to be tracing, right? We're going to be looking at some documentation and we're going to make sure that it is completely reported in the financial report, right? We're making sure that nothing has been left out. Okay, so when I say completeness, you say what? You're going to think of tracing. Okay, so the auditor should trace, but what are they tracing? Well, we're talking about revenue here. So if we're talking about revenue, the source documentation that would be directly corresponding with revenue would be something like the sales invoice, right? It could be the shipping documents. It could be that sales order form, right? We talked about what management would be generating when it comes to documentation as it relates to sales transactions. We're now going to be tracing that documentation to the report to test for completeness, right? So we would trace from the sales order form to the shipping document to the invoice that was generated all the way to the sales journal or the sales report. Okay, we could also trace it to the subsidiary ledger or the general ledger. All right, but keep in mind when we're testing for completeness, we're making sure that the source documentation is completely reported. Okay, so the auditor is going to want to perform a thorough review of all of the original source documentation, which might include those invoices, the shipping docs. It could even be the customer purchase orders, the cash receipts, and written correspondence made between the client and the customer. Right, some communication that says that this sale was made. Okay, so next test we have is going to be the cutoff test. So the cutoff test is ensuring that everything related to the sales transaction is in the correct time period. Okay, so if the sale was made in January of year 2, we need to report it next year, not this year if the sale wasn't made actually at the end of December. So frequently the auditor might see that management is trying to include a sale this year when really the sale took place next year. Okay, so we're going to want to analyze all large or unusual sales made in the last month prior to the end of the period. So customers might return items as well. So if something was returned, we want to make sure that that revenue was removed from the books. Okay, so if the sale took place this year and we recorded it this year, but the return might have been next year, we might need to go back and retroactively make that change. So another common item might be FOB shipping versus FOB destination if we're selling inventory. So we're talking about the transfer of inventory as of a specific date. Because we're transferring inventory at that specific date, on the sales side, we're saying that sales are also going to be recorded as of a specific date. So what is that specific date? That specific date is going to be based on whether this was transferred FOB shipping or FOB destination. If it was FOB destination, the sale technically didn't occur until the inventory was delivered to the front door of the customer. If it's FOB shipping, it's going to be transferred as of the date that the inventory was placed on the loading dock. Okay, so bottom line, we want to be looking at those dates. We want to make sure that everything is reported in the correct time period. Next up, we have accuracy. So here the auditor is going to be comparing prices to the sales terms referenced on the invoices, right? We want to make sure that everything is accurately reported when it comes to the sales transaction. If the client is saying that they sold inventory at a price of $100, we want to look at the sales price listing and see if the price of that actually was $100 at that time. All right, this is going to ensure some accuracy related to the sale. Okay, and finally, occurrence. We're trying to ensure here that the sale transaction actually did occur. Okay, so sometimes existence and occurrence are going to be interchangeable here, but basically we're saying that the auditor's telling us that what you see in the financial report, right, this sales line item actually did occur, and we have supporting documents that say that this actually does exist. So how are we going to confirm that? Well, we're going to take a look at the number that is reported in the sales report, and we're going to vouch backwards. Okay, so when you think about existence, we're going to be vouching, which is going to be going backwards, unlike tracing, which is going forwards when testing for completeness. So when we're vouching, and specifically as it is related to a transaction, we're going to be vouching from the sales journal backwards. Okay, so we're going back to the invoice, back to the shipping doc, back to the sales order form, right? This is the supporting documentation that management generated when designing and implementing this quote-unquote strong system of internal controls. All right, so we're assessing this by vouching backwards. And finally, understandability and classification. So here the auditor is going to be examining some reports. Why? Because they want to ensure that everything makes sense and that everything is classified properly. Okay, so the auditor should examine a sample of sales invoices for proper classification into the proper revenue accounts. Okay, so we talked about revenues. Let's talk about the other side of this. We're talking about expenditures. So this is very frequently going to impact expenses on the income statement. So again, transaction level assertions are going to be management telling us, the auditor, something about their income statement, right? Transactions that have occurred. So this is going to be more so related to purchases. Okay, so purchases that have been made and are reported on the company's financial statements will be tested by the auditor in a few different ways. And once again, this is going to be based on management's assertions, right? What it is they're telling us. When it comes to purchases, this is going to be similar to revenue in that they could be purchases made in exchange for cash or purchases made on credit. Okay, so this could be cash purchases or account payable purchases. Right, this wouldn't be a receivable anymore because we are the ones who owe the money. We're the ones buying it on credit. So debt that we need to pay back. So let's go through each assertion one by one and understand the appropriate tests that the auditor would conduct when obtaining audit evidence. So starting with completeness, the auditor is going to be testing for all of the source documentation that they see. They're going to analyze it and ensure that everything is completely reported, right? When it comes to expenditures, management might have the tendency to leave some things out. They might not categorize something as an expenditure when really it should have been, okay? So that's going to be a problem because if they don't include it, their bottom line is going to be overstated, right? Because profits are going to be impacted if we leave out some expenses. So when we're thinking about completeness, the auditor is once again going to be tracing, right? When I say completeness, you say what? Tracing. We're going to make sure that everything is completely reported, right? Nothing has been left out. So the auditor should determine the pre-numbered listings of the purchase orders as well as the vouchers and trace forward. Okay, so we're going to be tracing all the way to the company's purchase journal, right? So thinking about management's internal controls and thinking about how this documentation is being generated by management and ultimately recorded by the company accountants or the bookkeepers, we're going to be starting from document number 1 and tracing all the way to that final report. Okay, so we're starting with the purchase orders and we're going to be tracing all the way to the receiving report, all the way to the final report that is being presented. All right, so that purchase journal is where we would see a listing of all the purchases that management says that they made. Right, if we trace from the original source document all the way to the final report, that purchase report, then it's safe to assume that nothing has been left out. Okay, so remember, they very frequently refer to this as the voucher package when the accounting department would be comparing the purchase order with the receiving report with the invoice that was received. Okay, so very frequently you might see tracing from the voucher package to the purchase journal or to some other final report. Very important that we understand what they refer to when they're talking about the voucher package. Okay, so if you're still a little bit confused on that, it might be safe to go back to the previous modules and understand what this looks like when management is creating this documentation. Next up, we have cutoff. So again, we're trying to make sure that these expenditures or these purchases are reported in the correct time period. So what the auditor is going to want to do here is review all of the purchases in a given period. They're going to want to determine that the dates that are applied to vouchers are going to be dates that were recorded in the company's sales journals. Alrighty, so the auditor should also examine purchases that were recorded immediately before and immediately after the last date of the reporting year. Okay, so you might understand at this point what it is the auditor will be doing conceptually when performing cutoff tests, but what's even more important for you to understand is the documentation that they would be looking at. Okay, so that's the difference between getting this question right and maybe getting this question wrong. All right, so we really want to focus on what it is we're looking at when performing these cutoff procedures, right? We're talking about expenditures or purchases that are made, and we're focused specifically on the dates. Okay, so we're going to be examining dates related to what documentation? Well, the purchase journal would make sense because this is where they are ultimately reported at the end of the period, right? Think of the purchase journal as this summary, right? This is a summary of all of the different purchases that took place throughout the period. We're going to be looking at the proper dates and ensure that they are reported for the correct purchases that were made in this period, right? We're looking specifically towards the end of the year. We don't want to see that they did something like sneak this expenditure or this purchase in the following year, right? Oh, this purchase was made on December 31st, but how easy would it be if we just put this in on January 2nd, right? Nobody would notice. That's our job, the auditor, to sniff that out. Okay, so we're going to try to make sure that the dates related to the purchase journals correspond to what is accurately reported. Okay, so next management assertion we're going to talk about is valuation, allocation, and some accuracy related assertions. We want to make sure that this purchase or this expenditure is reported in the proper amount, right? It's accurately stated. So when we think about this information, we're specifically thinking about numbers that are being reported. So what is the value that should be correctly reported related to purchases or expenditures in the company income statement? What documentation would even give us this information? Well, how about the invoices that we received for making this purchase, right? The vendor sent us an invoice. Are we paying the correct amount? Are we paying the total amount? Is this net or gross of the total receipt, right? Maybe a discount was applied. So ultimately, the auditor should just recalculate the amounts that are reported in the company's vendor invoices. All right, so this is also known as a recalculation procedure. All right, that's going to confirm some numbers. Existence and occurrence. The auditor here should determine if expenditures were properly authorized and whether or not they're accurately presented on the company's receiving reports. Right, if they're properly authorized by this credit approval department, then we're probably seeing, okay, this transaction was approved, therefore they went ahead and properly made this purchase. If we're taking a look at the receiving report and we say, okay, Harold over here in the receiving department actually received it, well, then we see here in the receiving report that he confirms that. That means that the transaction actually did occur. So if we see that it was actually received in the receiving report, we also see that the inventory might be on the shelves, then it was probably ordered by the customer, which is going to be our client in this case. And once again, rounding it out with management's understandability and classification assertion. Everything we say about our purchases are understandable and classified properly. So the auditor is going to determine whether or not the company properly classified their purchases by simply examining a sample of the purchases themselves. Okay, let's talk about payroll. So payroll expenses are going to be located where? This is obviously going to be located in the income statement, right? Expenses are going to be salaries, wages, all of the various expenses related to direct labor. Okay, so with that said, we need to obtain an understanding of management's transaction level assertions. Management is telling us something related to the expense transactions that are located in the income statement. Okay, so once again, we're going to fire this off with completeness. When I say completeness, you say what? Tracing. Okay, so the auditor is going to be tracing, but what are they tracing? So this is going to be a source documentation related to payroll, which would be traced all the way to the financial report related to payroll. Okay, we're going from the source doc all the way to the financial report to ensure that nothing has been forgotten. So what is that source documentation that the auditor is going to be tracing? So how about timesheets? So timesheets are going to tell the auditor that employees have worked a certain amount of time, right? If they're working a certain amount of time at a certain hourly rate, then that expense should be XYZ. So the timesheet is going to be traced to the payroll ledger to ensure that nothing has been left out, right? So that we are testing for management's assertion of completeness. Valuation, allocation, and accuracy. This is another assertion that's talking about numbers. We're talking about the payroll numbers. We want to make sure that that expense is not going to be understated. Okay, so the auditor should determine the valuation of payroll expenses listed on the client's income statement by simply comparing the amounts recorded in payroll with the total amount of checks issued and are outstanding. Okay, so something else the auditor can do is view labor rates and compare them to the reported employee records, right? So if the client says they have a part-time employee that works for $20 an hour and works a 5-hour day, well, that means that they are getting paid $100 an hour. Okay, so we can back into that by taking a look at the labor rates and compare it to the reported employee records and payroll reports. Okay, so the auditor is going to need to perform a little 2 + 2 math. And finally, another test that the auditor can do that the exam likes to test is recomputing the mathematical accuracy that is being reported on a sample of payroll checks. Right, a copy of the payroll checks is going to be the cash that is actually distributed. So that's going to be a valid source doc for obtaining audit evidence related to the amount that's going out the door. All right, so next up we have cutoff. So when it comes to cutoff, we already know that we're ensuring that everything is reported in the correct time period. Okay, so simple enough. But more importantly, what documentation is the auditor going to be looking at when ensuring that payroll expenses are reported in the correct time period? So we're going to be comparing the amounts that management is reporting to what is actually being stated in the payroll report, and this is going to allow us to determine whether or not the transaction has been properly recorded in the correct time period. Right, we want to take a look at those dates and make sure that everything corresponds to what is being reported. Okay, and understanding that we're looking at the timesheets is going to be where those dates are going to be reported, right? If somebody says they're working in the last week of December and the second portion of that biweekly paycheck is for work that is done in the first week of January, then only 50% of this biweekly paycheck should be an expense reported in the current year. Okay, so when it comes to existence and occurrence, if we were tracing for testing for completeness, what does that mean we're probably doing for testing for existence? Probably means that we're going to be vouching. Okay, so we're going to be going backwards now to make sure that everything that is reported in this payroll report actually does exist, right? Nothing has been left out. Management might be tempted to not include everything related to payroll expenses because that would inflate the bottom line. Okay, so management's tempted to make their profits look more than it actually is. So we would be vouching. And when it comes to vouching, we're going to be working backwards, right? So we're going to be looking at a specific report related to payroll, and that report is going to be the payroll register. And the source doc that we're trying to see supports this amount reported in the payroll register is going to be amounts that are reported in timesheets. Okay, so the amount that the employee says they work for a given period. Okay, so going backwards from the payroll register to the timesheets to make sure that this amount is related to all existing expenses that have been incurred. And finally, understandability and classification. Okay, so we want to get a high-level overview to make sure that everything is understandable and classified properly. So the auditor is going to view a sample of paychecks and determine whether or not they've been classified into the proper expense items. All right, we want to make sure that everything is properly reported as an expense, not accidentally reported as a liability, or maybe forgotten altogether. Okay, so we want to make sure that everything is understandable, classified properly. Okay, transaction level assertions related to property, plant, and equipment. So we're either purchasing or selling off fixed assets. And this is going to have an impact to transaction level assertions. Because why? Because this is going to have an impact to the income statement. At what point would this have an impact to the income statement? Well, on the purchase side of this transaction, this would be cash going out the door, right? This would be an expenditure. All right, so the account balance level assertion would be the asset itself sitting on the balance sheet. But the purchase of this asset could be purchases related to fixed assets, could be purchases related to inventory. Regardless, this expenditure is going to be impacting the income statement. If we were to subsequently sell this fixed asset, it might result in either a gain or a loss from the sales transaction. That gain or loss is going to be reported in the non-operating section of the income statement, or it should be. Another thing to keep in mind, depreciation expense very frequently is going to have an impact to fixed assets. Okay, so we're going to have to take a depreciation expense. So understanding the methodology of depreciation is going to be important for the auditor. Did management apply the straight line method of depreciation? Maybe it was double declining balance, could have been sum of the year's digits. Regardless, this is something that we need to have an understanding of as auditors because this is going to impact the financial statements. Specifically, expenses are going to impact the income statement. All right, so let's get after it. As an auditor, what documentation, once again, are we going to be looking at when obtaining this audit evidence? So the documentation that you should focus on is going to be, once again, these fixed asset schedules, fixed asset requisition forms, loan obligations, impairment analysis, invoices, and we might be even looking at the general ledger and other financial reports. Okay, so bottom line, this is going to be the documentation that we are going to be looking at when obtaining the evidence we need related to management's assertions about property, plant, and equipment. Okay, so once again, let's fire this off with our completeness assertion. Completeness is going to be a little bit different here. So when we are obtaining an understanding of purchased fixed assets, how can we understand that these purchases are completely reported in the financial statements, right? Nothing has been left out. Well, when purchasing fixed assets, these are generally going to be made by first filling out a requisition form. And as we mentioned, it's generally going to be upper level management that puts in the purchase order. Right? These are the people who are going to determine whether or not we want to make a purchase of new fixed assets. These are generally going to be more expensive expenditures. So therefore, this is going to be an investment that is going to require a little bit more authority before we can just go ahead and buy new stuff. Okay, so the auditor can obtain a sample of assets purchased from the fixed asset schedule, as well as a sample of fixed asset requisition forms. And we're going to go ahead and trace them to the fixed assets that are actually located within the general ledger, right? When I say completeness, you think what? You think tracing. So nothing's changing. Once again, we're going to be tracing from source documentation to the report, right? That source documentation is going to be the fixed asset requisition forms. That's going to be original source doc number 1, which would be traced to the next source doc, which is generally going to be that fixed asset schedule, and then to the final report, which is going to be located in the general ledger. Right, the general ledger is going to list out all of the different major expenditures throughout the period. Okay, so additionally, the auditor can determine if any additions or subtractions have been made to the listed assets by examining repairs and maintenance expense items. Right, if an addition or subtraction was made to this fixed asset, it's going to impact the overall reporting related to this asset. right? We would not be completely reporting everything related to this fixed asset if we left out a major addition to the asset that should have been capitalized. Okay, so therefore any sort of major additions should have been capitalized and therefore should be recorded as an expenditure. Valuation, allocation, and accuracy. We're talking about numbers again. So when it comes to numbers, how do we understand the value of something related to the income statement when it comes to fixed assets? All right, we're talking about transaction level assertions. Expense items is specifically what we're talking about now, and this is going to be what we talked about when we discussed depreciation. All right, so that depreciation expense is going to need to be valued properly each and every year. Okay, so we don't want to incorrectly value the depreciation each period, right? So if we're using an accelerated depreciation methodology, this needs to be calculated properly. Okay, so how management decides to report depreciation is sort of subjective. As auditors, what we need to be on the lookout for is the overall reasonableness for how much depreciation is being taken. Okay, so for example, we're going to want to test for reasonableness of depreciation expenses related to the corresponding fixed assets by reviewing the methods of depreciation, right? We can review the accelerated depreciation methods if those are used. Those are generally going to be the declining balance and the sum of the year's digit methods. And if the client just applied straight line methodology, the same depreciation expense would be taken year after year. Okay, so something else that's going to be reported that's sort of subjective is the estimated useful life that the asset is being depreciated over, right? Who's to say that this machinery is going to last 20 years versus 10 years or 15 years? As auditors, we want to understand the overall reasonableness of this estimate because it's going to impact the overall depreciation expense each period. Okay, so that's valuation, allocation, and accuracy related to the income statement items as it pertains to fixed assets. How about cutoff tests? We want to make sure that the fixed assets that were purchased and sold shortly before and after year end are going to be reported in the correct period. Okay, so we don't want to see management overstating gains and understating losses from the sale of fixed assets. We also don't want to see them understating expenditures for the purchase of those fixed assets if it's going to understate the overall net income performance in the company's income statement. Okay, so management might be thirsty to overstate those gains. We want to perform cutoff tests, take a look at the dates, specifically by looking at the fixed assets that are listed in the fixed asset listings and understanding which dates that the asset was either purchased or sold. Existence and occurrence, what we see in the financial report needs to actually exist, right? So we're going to vouch backwards. We want to see that supporting documentation. Okay, so vouching would be the appropriate test for determining management's existence and occurrence assertion. Specifically, the auditor should vouch from what document to what supporting document. They're going to want to take a look at the receiving reports when the client has purchased fixed assets, and we're going to vouch from those receiving reports to the invoices. Okay, so the invoices that were sent to the client from the vendor. This is going to prove that what was actually received is based on what was actually paid for. Okay, so therefore that does exist if we see the matching documentation. And finally, understandability and classification. The auditor should examine all charges made to repairs and maintenance expenses just to verify that items have been properly expensed versus capitalized. Okay, so in addition to that, management will be prone to overcapitalizing repairs and maintenance expenses, which is going to overstate the client's asset account and understate their expenses. Okay, so that would overstate earnings. So it's important that we understand that the asset was capitalized when it should have been and expensed when it should have been.